Good morning, good afternoon, good evening, ladies and gentlemen. This is Brian Mitchell from Trade Algo. Welcome back. I wanted to create this video because I often get asked, Brian, how do you trade supply and demand? I know there's a video in my guidelines, so if you guys, when you log into the platform, go to Day Trade with Brian. Let's actually go to it together. See where my cursor is on the left-hand side of the screen? That's where I hang out and give trades in this chat. And before taking any of the trades that are produced in this chat, whenever they come, please read these guidelines. See here at the top right, once you're in the Day Trade with Brian tab, you click that. There's a little hyperlink that says click to view all of the rules. On page 6, there is some videos that I created as well as others on basically master classes. How to use the live options flow, dark pool prints that Eric created, how I personally draw support and resistance, how I use the 1 hour RSI, which is a tool that I love using, stop loss, risk management, etc., how to use the options chain on our platform before picking any contracts, and of course supply and demand that Ross created, another analyst trade algo. However, I did go over his video. I just went over it right now, and I trade supply and demand a little bit differently than he does. And a lot of people ask me, do you use an indicator or something? No, I draw it in manually because it's important that you do so. Not all supplies are created equal, and not all demands are created equal, in my humble opinion. Before we get started, I think now would be an excellent time for you guys to get out a fresh page of notes, and then you might want to title it Supply and Demand Notes, because the way we remember information, ladies and gentlemen, the way your lovely brain remembers information is repetition. Or strong emotions, you remember your breakups, your divorces, you're getting fired, because it creates a shell shock of emotion and it burns it in your memory. I'm not charming enough to give you strong emotions, but you do have control over the repetition factor. So whether you're writing with a pen and paper, whether you have to pause this video and get out maybe a notes, Apple Notes or something like that, right? Whatever it takes for you to repeat this information, because watching it once is like watching a complex movie like Inception. Did you fully understand Inception the first time? Probably not, right? We all had to watch it like 2, 3, 4, some of us 10 times, like before we're like, oh, I kind of understand it a little bit more now. Now a little bit more, now a little bit more. So I do the same thing with YouTube videos, folks. I watch the same YouTube video sometimes 5, 6, 7, 10 times, and my wife thinks I'm crazy. So pull out those notes before moving forward, and of course a disclaimer that this is all for education, folks. None of what we ever show on our website at Trade Algo should ever be misconstrued as financial advice. We are never telling you to enter positions. We say what we are personally doing as education. But if you guys choose to use that information however works best for you, go for it. Right? But we're not financial advisors. We never offer financial advice in any way, shape, or form. Goes without saying, but I thought we should start with that moving forward, just so we're all on the same page. But anyway, I actually looked up some of the most traded stocks that I've already charted most of these stocks. So I'm going to look together now that you guys have your pen and paper out, your notes, so that you can, again, you want to create this to be a long-term memory. You don't want to, ask me questions that are already in this video, because I'm going to tell you, I remember addressing it in this video. Go back and check it. If you didn't take notes, you won't know what point in the video. So next to your note, also put, 4 minutes and 23 seconds. Brian said this about supply, this about demand, this about why it was created, etc. So I think before we start looking at drawing supply and demand, I think it's important, what is supply and demand? So let me get out my, I'm going to try to make this as quickly as possible, give you just the meat and potatoes, but I also don't want to leave out information. So supply and demand, the reason why I use it is because A, it's newbie friendly, And B, it's a high quality setup, meaning with almost certainty, that since there's no such thing as a guaranteed trade in the market, if you're looking for certainty in the market, you're looking in the worst place possible. The market is a game of probabilities, but what can increase the probability is a high quality setup, something with Confluence, right? So supply and demand is a high quality setup in my esteemed, educated, humble opinion. All right, so supply and demand. Many of us know when we read an economy book that uh, the lower the supply, the higher the demand. But that's not the concept that we are looking at. It kind of is a little bit, but it's basically where big money institutional traders, the folks that trade with, you know, tens, hundreds of millions, sometimes billions of dollars, they identify a place on the chart where they believe the fair value of the stock is either undervalued or overvalued. And at that point, let's just say we're in a downtrend, right? Of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. And then some news dumps the market. They think, okay, whatever, XYZ stock is at 67.76, they think this is a great opportunity for us because, you know, we think that the fair value, it was overpriced at 80. It was still, it was pretty decent around, 72, but now we're getting a steal, right? So they create a demand zone. So there is a point on the chart where they believe this thing is a steal. So you will typically see, because institutional traders again trade with tens, hundreds of millions, if not billions of dollars. What happens when you inject tens or hundreds of millions or billions of dollars into a stock at a specific level where they believe, you see this, just an aggressive push up instead of the kind of, monotonous, lower lows, lower highs. You see a very quick push up. And that aggressive push is what we are looking for, ladies and gentlemen. That is what creates your zone of demand, right? So we start creating, and I'm going to show how to draw it, but I'm just explaining the concept of how and why they're created. Now, the same thing is in reverse for supply. Let's just say there's some euphoria. After that aggressive push up here, it starts going higher highs, higher lows, higher highs, higher lows, and then it reaches 84 points, 22. And then they think this thing is so overvalued. These people are all just, riding the hype train, and let's let it go a little bit higher, and then until this thing starts looking wicky and exhausted, and then boom, 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 it starts dropping aggressively. And that's what we are looking for, folks. We're looking for those aggressive pushes up where we can see that's an institutional trader, or an aggressive push down. It happens almost so quick that you end up, I need to get in. And that's how retail investors, they FOMO into positions. FOMO stands for the fear of missing out. That's usually how people lose a lot of money. But, those quick moves up create demand zones. Those quick moves down create supply zones. All right, guys? So now that we understand, how they're created, they are usually rinsed and repeated at least once. Not always, because again, if you're looking for a guaranteed, this works 100% of the time, again, you're not looking in the right place. The stock market is a game of probabilities, but what can increase the probability is big banks bought here for a reason. So once price starts coming down, aggressive push down, lower lows, lower highs, and then touches our demand zone, it's gonna try to recreate this move once again. So it's getting a little bit messy. So let's just say lower lows, lower highs, lower lows, lower highs, and then it gets really, really, this is a steal, and then they push it up, creates a zone of demand, right? Then you start getting, maybe some consolidation, higher highs, higher lows, higher highs, higher lows, something like this, and then they think, whoa, this thing is so, people, they were just buying the hype, all of this nonsense. Here was the fair value of the stock, and that's pretty much, we pushed it up, and then we let it kind of autopilot for a little bit. This is a fair value for the stock, and now the hype train, boom, they create a supply zone, and then lower lows and lower highs. When we come back to touch this zone of demand, the idea is to recreate this move as much as humanly possible. Sometimes you only get half the move, right? But you should get something. Why? Because they bought here for a reason, right? For a reason. Now, I do often tell people, I do often say that this is technical analysis. What can throw off our technical analysis, guys? Inside the guidelines, again, the guidelines are at the top of my room. Just open the hyperlink. Page 1, section C like Charlie, section C like Cat says, be sure to check out the Live Chat's Technical Analysis Bible. You just open the hyperlink after clicking on the green text. It takes you here. And this is a rule that I often say quite often, right? It's our job as traders to understand if a stock or the market as a whole is relatively strong, which if it's going to blow through resistances, and it's going to relatively weak, it's going to just blow through supports, and in this case, for purposes of this lesson, it's going to blow through our demand zones, because think of the demand zone as kind of like a zone of support. It's not a support line, it's kind of like a support zone, all right? It should hold, it should bounce, especially the first bounce. Why do I say that? Well, there's a couple rules. Number one, the first touch of a major support, or first touch of a demand zone, or first touch in a really long time. Let's say the 4-hour demand was created in June of earlier this year, and it's now September. So that's 4 months that the demand was created, and now it's the first touch on its way down. Is typically the strongest bounce. So sometimes it's the first touch, sometimes it's the first touch in a while, sometimes it's both. First touch and first touch in a very long time or a while is typically the strongest bounce, where it's going to want to recreate this crazy move over here. After it comes down, creates a supply zone, aggressive push down, lower lows and lower highs back into the demand, and then it's going to try to do this once again, guys. So I know my drawings are pretty bad. I know they're pretty crappy, but this is just to get the idea of how they're created, why they're created. And even if you didn't understand why, it really doesn't matter. The whole point, why was this zone created? Who cares? Billionaires, banks, and hedge funds had this information for a reason. It's our job just to use it to our advantage. Who cares if it's because of this or because of that? It doesn't really matter. You're looking for pockets of opportunity in the market, and supply and demand, in my opinion, is my go-to strategy a good, I'd say, a third of the time, if not more. All right, guys, so this is a simple strategy that I teach constantly in everyday live streams, and I tell people why I get in. So when you see me say it's at hourly demand, it's at 4-hour demand, it's at daily demand, you're going to know exactly what I'm talking about after watching this video. All right? So now that we understand what it is, let's get into how to draw it immediately. Let's not waste time. I might come back to this. Now let's go to one that I have not drawn yet. I've drawn coin, I've drawn ORCL, XOM, yes. Texas Instruments. I don't think I've TXN. Let's go to that one. I don't think I've drawn that one in because I want to show you a fresh chart that I haven't touched yet. I probably have touched this a little bit. Okay, not really. I just put an all-time high. Let me just really quick put that all-time high. I always put my all-time highs as a burgundy color. You guys can make them blue, orange, whatever, floats your boat. So I always, every one of these stocks, every single one you guys see here, I actually look at 105 symbols. I actually chart each and every symbol on the monthly, on the weekly, on the daily, on the 4-hour. Sometimes, most of the time, I'd say 80-90% of the time, the 1 hour as well. So let's start off with the monthly and see if we can find a zone, an aggressive push somewhere. Does anybody see an aggressive push of green candles anywhere on here before we get a red candle? If you guys are kind of eyeing the left-hand side of your screen, you would be correct. So here is a zone of demand. See this aggressive push up, all these green candles, green, 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 and before we get a red one? So that is what we are looking for, ladies and gentlemen. green, 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 green that just looks like it's skyrocketed off of news or just an aggressive push up, right? So what I like to do is get out, you guys can go to the shapes right here and go to the rectangle or whatever you guys want. I go to the rectangle and I go from the opposite color candle. Let's start off with the opposite color candle, this one right here. Before the aggressive push is how we draw our demand zone. So here's the aggressive push, do 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 do, and then we get our first red candle right here. So the zone of demand starts with this red candle right here. Everybody see that? Before the aggressive push. Remember, aggressive pushes up create zones of demand for buyers, and aggressive pushes down create zones of supply for sellers. So let's draw our, a lot of people start drawing it from here, the entirety of the candle, and then they kind of do something like this. I do not do that. So I know a lot of YouTube videos and other gurus or fake gurus, furus, they will teach that. I do not teach that. What I teach, ladies and gentlemen, let's start over, is to draw the supply and demand from the base of the candle. So again, opposite color candle before the aggressive push, from the base of the candle, right there, to the wick. So think of body of the candle to the very bottom, and then push it out. Everybody see that? Now, this is something I do personally, ladies and gentlemen. I draw, I give the borders of my zones of demand a certain color, a unique color, so that I know what time frame it is. My dark purple is the monthly time frame. My light purple is a weekly time frame. My aqua green is the daily. My orange borders are 4-hour time frame, so on and so forth. And that's why I put it in the Technical Analysis Bible, so that it... Whoa, sorry about that. My chair just snapped out of position. So that if you guys see my charts, and I actually do share them from time to time, you guys can be like, oh, that's a monthly resistance. He has dark purple borders. Now let's see, did it bounce from demand? Was created over here, kind of danced around, and boom! Did it recreate this move over here? Pretty darn close. Pretty darn close. I mean, I just picked this one on a whim. I had no idea how well this one was going to give us a good example or not, but it seems like I picked the perfect one for us. So see how it came down here? As soon as it touched demand, boom, just skyrocketed. Came back down 3 months later, boom, skyrocketed again. And then almost a year later, boom, crazy how that demand zone works. Now, this is why I encourage you guys to read the Technical Analysis Bible. I do every single day. I know that might seem obnoxious to some folks, but the reason why I read this every day, it's only 6 pages with really big font and a lot of spaces. It takes me literally 2 or 3 minutes every morning. I do it religiously, like brushing my teeth or wiping my rear. I don't skip it, ever, never. Because I remember it took me 2 months to solve a Rubik's Cube. And then I put it down for a month, and I thought, it took me a long time to learn how to solve that thing. And then I picked it up a month later. I forgot everything, guys. I forgot everything. So your mind is like a muscle. It's the same thing with the gym. You don't work out for 3 months. Is your body going to be nice and chiseled like it was 90 days ago? No, no. You don't use it, you lose it. Right? It's the same thing. Your mind is a muscle. So if you stop working out your physical muscles, they will atrophy and wither. It's the same thing with the neurons in your brain. It's the same exact concept. So I read this every day so my brain is primed on what to look for. And the reason I bring this up is because we are starting to draw our supply and demand on the monthly time frame, and picked an awesome example. And the bigger the time frame on the charts, the more reliable a support, a resistance, a supply, a demand zone, the one we just drew, a simple moving average, everything is going to be more reliable on the monthly than the weekly, on the weekly than the daily, on the daily. For those, and I say this because I see a lot of people who use the 2 and 5 minute and 10-minute time frames, and which I never use, right? I never ever use them, especially in this choppy environment. It weakens the time frame you're looking at substantially, guys. I don't know if you know that chop weakens your time frame substantially, and that's why I look at nothing less than a 1-hour chart. So you won't, ever, it's going to be rare for me to say 5-minute demand, 15-minute demand. Ross can do that because Ross, he scalps in momentum trades, and maybe Dane and others do that, but I look at nothing less than a 1 hour demand zone, period. So just so you guys know my style, because I, again, understand that the bigger the time frame, the more respected everything is going to be. I'm going to trust a 4-hour demand than an hourly demand. I'm going to trust a daily demand over a 4-hour demand. Now, sometimes you do have a daily within a 4-hour. They share the same candles, and we're going to get, hopefully, find an example of that. But you guys can see that multiple rules are used in here. So rule 3 of my technical analysis Bible, obviously the monthly time frame. The monthly time frame is a big time frame. It's probably the biggest one that I use. I don't use yearly time frames. Of course, it's going to be respected. Of course, and also the one we just saw not too long ago, rule 12. The first touch of a major support or first touch in a while or a long time is typically the strongest bounce. Look what happened over here, guys. So it went up after testing 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. A whole year. Is that a long time between here and here? Absolutely. So first touch in a long time, the first touch of a major support, or first touch in a while or a long time is always the strongest bounce. Did we get a pretty strong bounce? It's actually bigger than the last one. So high time frame demands, juicy, 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 juicy. Love them, love them, love them, right? And it even created a new all-time high. And there's probably some news that, went with that. It wasn't just the demand zone. It was the demand zone plus news that pushed it further and higher, right? So let's... I'm going to find a supply zone, but I don't see any here yet. So that's how demand is created. Now, before we move to drawing supply zones, which is just the same thing in reverse, we're looking for an aggressive push-up, opposite color candle, base to wick, and then we're going to look for an aggressive push-down, opposite color candle, base to wick, right? So let me show you where I personally, again, no financial advice, where I personally grab demand. Now, there's 3 places, ladies and gentlemen, 3 places that I typically like to grab positions in a demand zone. Number 1 is the top of the demand zone, the very, very, very tippy top. So let me actually get rid of my paint tool and see exactly. This is 145.51. Hopefully it's not too blurry. But see how I'm just kind of bringing the price, and I'm just going, what is it exactly? It's 145.51.47 or something like that. 145.47 is where I would grab a piece of this demand. See how it was created over here, and this is the first test. Remember the rule we just saw. The first touch of a major support is typically the strongest bounce. So where I would have grabbed a piece of the sucker is 145.47. Now, do you go all in here? No, because there's 2 other places this can bounce, ladies and gentlemen. It can also bounce in the middle, and it can also bounce at the bottom. All right, so what do my allocations look like at the top? Let's just say I'm trading with $1,000, typically normally. This is my normal full-sized position. So typically, this is where I want to start inching into my position in case I have to average into the other 2 positions, position 2 and position 3. So here I probably put 25% of my total capital, right? Maybe $250 as an illustration, as an example here at the very top of the demand zone. Now let's just say it's more bearish than anticipated and it goes to the middle before popping upwards. I would deploy another, let's say 30% here. So 25% at the top, maybe 25 to 30% here in the middle. So I'm going to say $300. And if we subtract $250 and $300 from 1,000, we're left with $450. Here would be about 40-45% of my position right here. All right. So the last 450 will be right here. And let's see what happens, guys. So this is how I personally get in. I have a set amount per trade, and that goes per my guideline 1. The most important rule when I tell people, please memorize this document, I beg and plead, because you cannot trade without rules. I see newbies all the time just excited to make money. That's like jumping into a football game. I'm excited to play football, not knowing any rules. And then you go straight to the hospital and you're like, why did I get a rib broken? Because you ran into the field and you had no idea that people could tackle you. It's the same thing with the market. You need to protect yourself. And it's like, and I don't want to read the rules. That's like saying, hey man, where's your armor? And you just have a sword. Where's everything else to protect yourself? It's alright. It's too annoying to put on. Dude, you're going to die. And I say that, yes, with humor, but also it's just to illustrate how silly it is to trade without rules. You should have a set standard position size. I personally, for the trade tracker we have in section L, like Lima, section L like Larry in this document, is 2,000. So but for purposes of this lesson, I'm using, but if it was 2,000, I'd probably put 500 here, I'd probably put another 600 here, and I'd put the remaining 900 here. So this can vary from person to person. Your entire account might be only $1,000, so your position size might be three trades a day, that's $300. So 25% of 300 would be $60 here. Probably, let's just to make it a nice even number, $60 here, and then wait, 30. So 20, 25. That would be. My math is off today. What's going on with me? 7. Excuse me. So 75, 75, 150 here at the bottom. If your set position size is 300, so you could take 3 trades a day, right? Because I get this question quite often. How do I inch into demand? So this is one example, right? Now with options, they are highly leveraged, time sensitive. So if you got in with $250 here, your 100% return was not that far after. It was pretty darn close. At 100%, you should always take your initial investment off. Should, again, no financial advice. I cannot stress that enough. And then you're just playing with you're playing with house money at that point. Now, where do I put my expiration date? Again, this is why I tell people, please do not ask me questions if you guys have not read both these documents, because people ask me this all the time, choosing strike prices. If you're taking trades off the monthly time frame, you have to give yourself some time. So if we're playing demand on the monthly time frame, I would have gave myself at least 3 weeks an expiration date. But this is why I look for maybe daily or 4-hour demands. I could probably use on a 4-hour demand, same day expiration, maybe on the daily time frame if it's the beginning of the week, right? Maybe, because it might dance around in demand for a while, right? And if you take the trade on Wednesday and it stays in demand for 4 days up until next week, and you chose this Friday's expiration date, you're kind of screwed, right? So there is a method to the madness, right? So let's kind of zoom in a little bit, because I do want to find a supply zone now that you guys now have under your belt of knowledge why a supply and demand zone is created, what they are, where to inch into a position, how to draw them. Now let's zoom in, right? Because I always look at the weekly, monthly, every time frame, right? So I don't see any succession of green candles to create an aggressive push up, and neither red candles for a push down. Let me see if I can find some over here. Interesting. So here's a push up. This is a demand that has never been tested. Huge push up. And here's another little tip and trick. How do I know if it's a strong demand, Brian? Well, you want to look for a break of structure, right? So what is a break of structure? A break of structure is identifying the trend of higher highs and higher lows, and did the push up break the previous higher highs and higher lows? Well, let's look. Let's look at the price action over here on the left-hand side of the screen and see, did the aggressive push up break through the higher highs and higher lows? I'd say so. It broke through all of them before we got a red candle. So this is an aggressive push up. This would be a very reliable demand, right? So you want to look. So here is the flip side of that. Let's just say we have higher highs and higher lows, comes back down, and then pushes up aggressively. But it does not get over the last, it did not break structure. It does something like this. Higher highs, higher lows, higher highs, higher lows, higher highs, and then it starts dropping, pushes up aggressively, but does not break the previous structure of higher highs and higher lows. Does that kind of make sense? It has to be super obvious. It just breaks through all of the previous remaining. That's how you know you have a reliable demand. So almost forgot to mention that in this, and the same thing goes in reverse for supply. But I don't know if I'm going to find a supply zone. This is like an up only chart. This is crazy. Let me look at another stock. Let's take a look at that's one that people like. PM Philip Morris. MA MasterCard. I know people trade that MasterCard quite a bit. All right, let's go to MA. I don't know. I don't think I have that one charted. Start with the monthly time frame. Here we go. Is this an up-only chart also? This is silly. All right, these are, I'm finding up-only charts. I need to find something with a little bit more volatility. Let's take a look at Morgan Stanley. This is probably like Coca-Cola or Citi. I'm going to guess this is an up-only chart also. MS. Some volatility. Okay, good. So check this out, guys. Here is I think I picked a good chart. Supply is the opposite, the exact inverse opposite of demand. For demand, you're looking for aggressive pushes up, a bunch of green candles in succession that break the previous, make a break of structure, and clearly break the higher highs and higher lows, or lower lows and lower highs that it had before. And supply is the exact opposite, an aggressive push down that breaks the previous structure. So, does everybody see which is the most aggressive push that you see on this chart? Of course, right here on the left-hand side of the screen. So, aggressive push down. Look at this cascade of red. Boom, 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 boom. This is our first green candle. Did it break the previous structure that it had? Abso-freaking-lutely. Yes. That's the check mark, by the way. So, yes, it did. Even through the wicks. I don't look at wicks. I look at bodies of candles because there's a reason why it closed at the body. One quick sec, guys. Let me turn something off on my phone really quick. All right, excellent. So, this is our zone of supply. So, we already know how to draw it, but again, I do not draw. So, opposite color candle is right there before that cascade of red. This is the candle that created the zone of supply. Just to reiterate, I know I said it for the demand, but I'm going to reiterate it for the supply. I do not draw from wick to wick. This is the incorrect way to draw supply, in my opinion. In Brian Mitchell's opinion, he's a dummy sometimes, so take what I say with a grain of salt. I always advocate, do what's in your best interest, but I do not draw supply like this from here to here. I do not. I draw it from the base of the candle, the base of the candle. Let me make sure that, and with monthly time zones, you want to make sure that this is accurate. So I always zoom in. See how I'm off by a little smidgen? Make sure it's accurate, guys. Let me even zoom in further. See how it's not accurate? And I almost forgot that in the lesson as well. Sometimes with monthly and weekly time frames, you just have to keep on zooming in and like, did I get it correct? No, I still don't have it correct. Isn't that crazy? Look at that. So it has to be precise because sometimes it touches supply to the exact penny. There we go. So the bottom of the supply zone is 39.67. Let me zoom out. This is crazy. That was crazy, right? I'm really glad I went over that. And the same thing for the top. I'm not going to zoom in, but you guys understand the point. So we draw from the base of the candle to the wick, right? Now the first test is typically the strongest rejection. So let's kind of zoom out and see how this played out. So around 39.72, did we get a rejection? Let's see if Brian was correct in his analysis. Oh, gorgeous. Gorgeous, gorgeous, gorgeous. And this, again, this is not scripted. I had no idea MS was going to give me a supply zone, but you can see that this is it works infallibly, almost infallibly, I should say, because again, there's no guarantees in the stock market. There's no such thing as a guaranteed trade. So here we're trying to recreate this move. For whatever reason, billionaires, banks, and hedge funds thought, nah, whatever news is creating whatever. It could have been earnings. It could have been something. They're like, yeah, this company is not worth $39.67. Boom, and they sell offload tens or hundreds of millions or billions, maybe even tens of billions, maybe hundreds of billions. Like when Nvidia lost like a trillion market cap one day or something like that, something insane. Earlier this was it this month? I think it was last month. In 2024, August or September, I can't remember now. Days are kind of blurring together. But we're trying to recreate this move as soon as we touch the bottom lip. And I said, we usually go for at least half if you can stomach it. So again, it can reject at the bottom, middle, and top. If we're playing with, let's just do $500, right? 25%. Again, feel free to adjust these numbers. For you, you might be conservatively playing 20% at the bottom, because what if it goes all the way over here? It's very, very possible. It's extremely possible. So let's just do 25% of 500 would be $125. I would deploy right here. It looks like, yep, I never got to deploy that next 25% of my position, and boom. Did it recreate at least half the move? Yes, it did. Now, does it always hit half? No. But that's why it's encouraged to raise your stop loss, take profit, raise your stop loss, take profit, right? This is the measured move. Will we always hit an ideal target or entry or measured move? No. News can, again, throw off your technicals so easily. And people overlook this rule. It's probably the most important one on this document. On this document, it's position sizing, the guidelines document. But when you guys open the Technical Analysis Bible and you read it every day like I do, this is the most important rule. Your technicals are going to turn to garbage if there is, euphoria in the market. Say goodbye to your resistance levels. Sometimes it blows right through a supply zone, especially a low time frame supply zone, right? So let's go back to MS. It did recreate some of the move. We never got to deploy more of our capital at the middle and top, but let's see how it performed once it got to the top of that supply zone. Did it reject from the top of the supply? It sure did. Check that out. It looks like the opening of the month opened above the supply, and then boom, went to the bottom of that supply. So it still gave us a pretty decent move, guys. So bottom, middle, and top. Demand zones, top, middle, and bottom is where I typically jump in. Now, there's another thing I would like to discuss that is debated amongst traders. This, at some point, is going to break. The supply zone, at some point, is going to break. When is the supply zone no longer valid? When we get our first candle close above it, it's no longer supply. Now, some people would postulate that it goes from supply and it flips into demand. Ross is not one of those traders that believes in supply-demand zone flips. I kind of do. And I say kind of because it's not as reliable as just basic supply or demand. But can it work? Yes. Check this out. And again, it's almost like I picked the perfect example. We got our first candle close right there above it. An open doesn't count because as long as it opens and closes back inside the demand, and you might want to write that down again, an open above the supply zone does not count. An open below the demand zone does not count. You want to look relative to the time frame, and before the month ended, we opened above it and we did close back inside it. Supply is still valid, and it was valid for 1, 2, 3 more months, and the fourth month is where we finally got a candle close. You want to be looking for the candle close, not the open, the candle close to invalidate the supply. So, first candle close was this green candle right here, went up. Did we use this as a zone of demand now? Well, demand zones We buy at the bottom, excuse me, top, middle, and bottom. Top of the, whoa, middle, whoa, bottom, beautifully. All three of those played out. Isn't that crazy? So this is a great example for a supply-demand flip. Let me zoom back in. This is crazy. I almost put, so this one, this green candle on the monthly time frame, supply, no more. If you believe in supply-demand flips, this zone, leave it on your chart, it is now demand. So in demand, we bounce off top, middle, and bottom. Did we bounce off the top? We sure did. Did we bounce out of the middle? We sure did. Did we bounce from the bottom? We sure did. But what would invalidate a demand zone? A candle close below. Again, not an open. This was an open. This was an open and it went back inside and closed. Demand is still good. The close is what we're looking for to no longer. So valid question, would this flip back into supply? No. At that point, both of them are dead. So you only get one supply-demand flip. And play around with this. And this is why I always suggest journal all your trades. The people that are learning techniques and not journaling, I tell them it's going to take you 10, 15, 20 times longer because you're not going to know where you're making mistakes. I personally, in my journal, saw, oh, this trade didn't work, 5-minute demand, 5-minute demand, 10-minute demand. I'm like, I need to stop using 5 and 10-minute demand zones. But you're not going to see the recurring red and seeing the same thing over and over if you're not journaling. And I see 90% of people just want to employ indicators and oh, I'm excited to use supply and demand now and not journal. It's going to take you way longer. And I say this with love because I want everyone to succeed in here. And it's not like it takes 10 minutes, guys. If you took 6 trades, go back, look at the history on your broker. Why did you take that trade? Oh, yeah, maybe the lower time frame demands don't work for me. And for me personally, that's why on my journal, I won't touch anything less than a 1-hour demand. So I think I've gone over. Let's go over let's go to the weekly time frame. I'm going to use the same chart, and I'm just going to start drawing supply and demand zones. Do we see any aggressive green candles? Not really. I don't see any really aggressive. Oh, right here. Everybody see this? Huge, huge green right here. It's almost like it went vertically. Kapow! And yeah, definitely broke the previous trade, break a structure right there. So opposite color candle, base to wick. Again, watch the video over again if you guys need to. And again, for the high time frames, you got to zoom in, zoom in, zoom in. I'm not going to do that for this session, but you guys get the gist. Yeah, we got a close below. Ouch. So that invalidated this demand zone. It did bounce off it initially. So let me show you. So weekly time frames. See how this pushed up? Our first touch of that demand zone was right here, this green candle. And it actually went past the bottom. You would have entered here, here, and here. Now you're in a full-size position and waiting for the candle to close. And all three of your averaging in paid off handsomely. And then you would have got out at supply. So it did get invalidated literally the next month over. But hey, you made money off the first touch of that demand zone. So now let me move on to the daily. I do this over and over and over and over, guys. So let me go to the daily time frame. And again, once a demand zone is invalidated, I just take it off my chart. I don't mess with it anymore. So this, as soon as I got that red candle beneath, I would have just, whoop, get out of here. No mas. No maschenko. All right, so we were in a range for a while. Do I see any daily? Let's just go through the most recent price action. I was just trying to find examples. Ooh, pretty aggressive push down here. I like that. Everybody see how, look at that red. Whoa. Opposite color candle, base to wick. Base to wick. Zone of supply. My dailies are... Oh, yo, look at this. You can't make this up. Bottom, sometimes you get in a little bit early. Middle, oh man. Man, oh man. crazy. Moves down here, definitely went past half, or at least half. Now went past half. So this was beautiful. This was beautiful, right? Now if you're taking a trade off the daily time frame from the bottom lip of that supply back to the technical analysis Bible, you might want to print these out. Daily time frame, I have to give myself 2 to 4 weeks. Let's see how long it took for that move to manifest. So each of these are 1 day. Monday through Friday is the days that we trade. So we get 5 of these a week. I might have entered here. 1, 2, 3, 4, 5. Entered it in again. 1, 2, 3, 4. So this one took 2 weeks. Everybody see exactly why, excuse me, I say it matters how much time you give yourself. This one took 2 weeks for the full move to happen because we took it off the daily time frame. That was a daily supply zone. Everybody see that? And it took almost exact magic number. I did not rehearse this. I did not plan a perfect lesson, but it's just turning out that way. So let's go in on the 4-hour time frame. So is this supply still valid? Do we have any candle closes above it? No, it's still valid. And we haven't tested it since for 1, 2, 3, 4, 5 days. We might go back up and test it again. I'd like to see it longer than 5 days so that, the longer we stay below the supply, the more it kind of, marinates. And again, first touch in a while or a long time is typically, this is for demands, the first touch of major resistance or first touch in a while is always the strongest rejection. So the longer we stay underneath this supply zone, maybe another 2 weeks, come back and rinse and repeat. Will you rinse and repeat the same thing over and over? Just do? No. Because, again, this is why I stress always, please read this. The more we test the resistance with frequency, the more likely we are to break it. So you can't just rinse and repeat supply over and over, right? You have to start getting cautious on tests 3 to 6. Test 3 to 6 is typically when we break, especially if we do it back to back. So with MS, first test of the bottom, first test of the middle. But if we started testing the middle more than once, especially with frequency, I would have been like, maybe it's time to ditch this trade or reduce my position size. So what the candles do matters, and you're only going to tattoo this on your brain the more you read it, because how we remember information is repetition, repetition, repetition. So the last thing I'll go over, ladies and gents, is earnings gaps. Earnings gaps also create demand zones. And let me go over Carvana, might as well. Because here we go. The last time we had a significant gap for earnings was not the previous one, it was actually here in May. Everybody see this green candle and then this rocket ship upwards? This still counts as like a big move upwards. It's still an aggressive move upwards. This kind of gap, you kind of have to think to yourself as like a cascade of green candles. It's still an aggressive push upwards. So where is the opposite color candle before that aggressive push up? You guessed it, it's right here. Now this is also, again, I'm glad I actually covered this. This is what I call a weird demand zone, because the 4-hour demand zone, green, 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 and our first red candle is here after the aggressive push up. So where's the opposite color candle before that aggressive push up? Green, green, green. It's right there. It's that red one right there, right? But on the daily time frame, it's above the 4-hour demand. This is what I call a weird demand zone. And do they work? Yes. Yes, they do. Sometimes price comes down, lower lows, lower highs, lower lows. Boom. Never touches the 4-hour demand. So this is why I chart it on monthly, weekly, daily, 4-hour, and hour. Because sometimes if you're only charted the 4-hour and you didn't chart this weird one, and it bounces right, in the middle, and it never touches the bottom, you might have never got your entry, and you're waiting for that 4-hour demand because you missed the weirdo, the weirdo one. Now, same thing over here. Here's a 4-hour. Let me see if I can find. I'm probably going to find something on the popular stocks. The last thing I'm going to end with is Confluence. It's nice. It's actually really nice, I should say. Not just nice. It's actually really nice when you have a demand zone, right? Huge push-up right here. Everybody see this big push-up right here on the left-hand side? This is Tesla, and today is September 7th of 2024. Huge push-up. Did it break the previous higher highs and higher lows? Yes, it did. So it definitely created a break of structure. So we go from the opposite color candle before that break of structure right there, and before that aggressive push-up, base to wick, and that creates our zone of demand. And we haven't tested this yet, guys. We have not tested this yet. Now, this also, I'm going to show you this blue line right close to our hourly demand. Let's go to the daily. Everybody see this with blue line? This is the 100 simple moving average. Look how we bounced off of this 100 simple moving average. Boom! We haven't tested this 100 simple moving average since August. So it's been, about a month since we tested this. And again, I keep on going back to the rules because they work like clockwork, guys. But you're not going to know them unless you really know them through repetition. The first touch of a major support or first touch in a while is typically the strongest bounce. So we have the first touch in a while on the daily 100 simple moving average. And we have the first touch of demand since it was created back here. We haven't touched this demand zone yet. So this is like a double whammy. And this is what I say by look for double, triple, quadruple supports. Here and demand, that is what we call a high confidence setup. Lower lows, lower highs. This is where Brian says size up. Everybody see that? How you have a support here and the demand zone that you created. So you always also want to look for confluence, guys. And also, let's go to the technical analysis Bible. This is a triple whammy. This one's beautiful. I'm probably going to use this one later this week if it's not overly bearish because of stupid news. Let me actually, that is a very high confidence setup because there's a gap here that hasn't filled. What happens when gaps fill, ladies and gentlemen? Man, this document is gold. I should probably charge for it. Once the gap is closed or filled, there's a high likelihood price will reverse, a good 80% plus chance. So look what's going on with Tesla. There's a gap that was created over here on the left-hand side of the screen. It went halfway, never closed the gap, right? But what's close when the gap fills? The 100 and the demand zone. So once gaps fill, price reverses. Might want to touch the demand zone for the first time and the 100 simple moving average, and boom, just rocket ship up. So you have 1, 2, 3 things for confluence. So that is supply and demand, guys. That is sometimes you're going to get some really wide demand zones. I prefer the ones that are thin, but sometimes your demand zones will look like this, and those are tricky to play, guys, because you're playing bottom, middle, and top. You're stretching yourself quite a bit. So try to look for the demand zones that are, relatively, if you have to average in at the bottom, middle, and top, or, bottom, middle, and top, or top, middle, and bottom for demand, vice versa for supply. The thicker ones, try to stay away from. But other than that, guys, YouTube, I didn't pay a single dime or penny to learn this information. It's just independent research. And like anything else, how bad do you want it? If you want to get good at karate, you're not just going to look at one video and all of a sudden you're a black belt. It doesn't work that way. You're going to have to go to class and practice. And in this case, what is our practice for trading? Paper trade, journal. Paper trade again, journal. What is working? What time frame works best for you for supply and demand? And what works best for your emotional temperament is everyone's emotions are very different. Some people are calm and stoic, and they're okay with it going. They're okay with price doing this for a while. Bottom, okay, middle, top, and it hangs out here for 5 hours and then it bounces up. Some people panic if it doesn't get an immediate bounce. So you might want to go with the lower time frame demand zones, but everyone's emotions are different, guys. This is why, please, paper trade, journal. If you're not journaling, you're likely not trading correctly, and you're likely not green. because when I started journaling, I think Ross says the same. Like, don't quote me on it 100%. But once you start journaling, you start seeing, oh, I keep making that mistake over and over and over again. Oh, I don't do well with the big time frames. I don't do well with the small time frames. How you trade, no two traders trade alike, ever. So this is a lesson I would humbly recommend to watch more than once. I put as much detail in it, so I hope you guys took down notes. I went over why they're created, how to draw them, where to get in, supply demand flips, even weird demands, demand and supply zones with gaps, right? Because of earnings or news or something like that. Where to buy, finding confluence on the supply demand. We went over a lot, so you might have to watch this video more than once. Please put down in your notes the times where a certain topic is discussed. I think I went over everything as best as I could. And on that note, guys, let's crush it this week. I'm gonna show you one more example, just because we're already here. uh, huge drop right here on Tesla. And this was earlier last month. Check this out, guys. Can't make this up. Huge drop. Opposite color candle, base to wick, came back up. Touched the top, rejected. Touched the top, rejected, and almost recreated the entire move, which is insane. Did news kind of help? Yes. Sometimes news will work in confluence with your technical analysis. And just, go for your measured move. Half, and if it creates the full move, just kudos. Amazing, right? Alrighty, guys. If you guys have further questions, again, I could be reached at brian@tradealgo.com. If the question you're asking is addressed in the video, I'm going to politely and respectfully just ask you to watch the video again, because I know I created notes on what I discussed, and want to encourage accountability and responsibility, because trading requires such. Trading is not just give me the trades and I'll get rich by taking trades. It's learning how to fish for yourself, and this is a high quality setup and strategy that, again, I think is newbie friendly, and I think is recreatable if you're disciplined, if you take down notes on what works for you and what doesn't, and you're strict with how you draw your supply demand, not rinsing and repeating, reading the technical analysis Bible rules. And this is literally thousands of hours. I'm not even joking. Thousands of hours of me researching on YouTube, and my wife thinking I'm crazy. Stop watching that. Watch the movie. Nope. I'm going to learn this until it's tattooed on my brain, until I'm sleep talking technical analysis. That's how bad I wanted it. So email me, guys, if you guys have anything else. I hope this serves you well in the future. I hope this lesson was enlightening, and let me know how else I can help you guys. Everyone, as always, have a wonderful and blessed day, and I'll see you guys in the next one. Everyone, take care.